All right, testing for sound. Testing for sound. Just do me a favor and put a 1 in the chat box if you're hearing the sound all right now. And we got a very important topic. So obviously having the sound working for you guys is a big deal. So just go ahead and put that 1 in the chat box if you can hear me well. All right, I'm seeing a lot of 1s. Great. So yeah, definitely hearing is a big part of communication, especially with a topic like this. So we're going to talk about self-employed people loving taxes, or at least not hating taxes quite as much due to a new deduction, the QBI deduction. And we're going to work in this training on understanding and optimizing this deduction as tax professionals. So I know it's on a lot of people's minds, and we got, I feel like, an information-packed training for you guys right now. So let's get started. As you guys know, from having self-employed clients, being self-employed is obviously a huge challenge in a number of ways, and then you got to pay taxes on top of it. I know everybody else does as well, but there is a certain feeling among self-employed clients, right, where occasionally they feel like I'd rather get a root canal than go get my taxes done, right? It's not exactly tops on their list of things they want to do. And now suddenly we have actually really good news for self-employed and business owner clients. A brand new deduction, 20% of net income, and it's actually pretty amazing. I'm surprised that it is such a generous deduction. However, due to complexity and just really plentiful gray areas, how good this news is for our clients, especially certain client groups, will depend on how good we are as tax professionals. So it's something that we really want to focus on and hopefully give you a competitive edge with this training. So let's talk about the goals for this training. Make sure that you're in the right place, that we're doing, meeting and exceeding your expectations. Goal number 1 is to more fully understand in an actionable way. We're right before tax season when we're filming this training. So we really want to make sure this is actionable stuff that you guys can use, today, tomorrow, and put to use right away. And particularly focusing on the not as well understood aspects of the QBI deduction. So hopefully you'll learn some new things, maybe get some questions answered. Secondly, we'll want to identify some potential methods of optimizing these not well understood aspects of the QBI deduction. And then last but not least, want to do some live Q&A. I'm actually a little bit nervous about this Q&A because I feel like you guys are probably going to stump me a few times. I mean, this is all kind of new. But hopefully when I bribe you with some free gifts, that'll make up for any questions that I can't answer. But I'm definitely going to do my best to answer as many questions as we can at the end of the presentation. All right, so I am a third-generation tax business participant. I come from a family tax business, done a little over 10,000 tax returns, founded Pronto Tax School to help my fellow tax professionals, and been privileged to help you guys with tax credentials and training. I'm actually a multi-entrepreneur, so I feel like I have multiple businesses that are kind of make me very interested in QBI for my own situation. So I've kind of looked at it in depth in that way. I do want to give a lot of credit, and let me know in the chat if you guys agree that there really have been a ton of very good QBI articles, ebooks, and training since the deduction came out. I feel like it's been really great. I want to give a special credit to Tony Nitty at Forbes. If you guys are not familiar with his writing on this topic, it's actually amazing. I mean, you can just read his articles and really he's got some amazing examples, just done a great job. Still, as we head into tax season, I do have some questions. And specifically, what are we going to cover in this presentation? What are the questions that we want to answer for ourselves and make sure we're ready for tax season? So what inputs do I need to be concerned with on my tax software to make sure that QBI triggers properly? Because this is kind of a software usage issue at some level. And specifically for the phase out situations where people start losing the QBI deductions, I'd like to see those worksheets and see how those phase outs work. What about this idea of carrying over unused QBI to an upcoming year? How does that work? What's the impact on the S corporation tax treatment? Obviously, a very popular tax treatment for small businesses. And last but not least, how do I turn non-optimized QBI situations? So it will happen that there are situations where the QBI is not in the best place it could be, the QBI deduction. And is there an opportunity to turn those into paid tax planning engagement. So we got a few things to cover. Like I said, it's going to be a pretty intense, fast-paced training. Probably will be a little more on the advanced side for some of the folks that are a little bit more beginners. But I know it'll be some questions that are probably on your mind as well. All right, so just to briefly recap, I think that majority of you guys that are on this, you already know this. The fundamentals of the deduction are fairly easy. It's 20% of net income for pass-through businesses, Schedule C, S Corp, partnership, Schedule E, rentals mostly, and 20% of net income, but not more than 20% of taxable income, and not counting capital gains. So it's basically a comparison between the net business income, but it can't exceed 20% of taxable income. It's on line 9 of the new postcard 1040. I'm sure you guys have taken a look at that. And there's this idea of, possibly no soup for you, kind of like the soup Nazi from Seinfeld, a very important TV character, where when your income goes over, your taxable income goes over a certain amount, for married filing jointly, it's $315,000. Then there start to be phase outs, limitations, disallowances of the QBI deduction. And also there's this idea of specified service trade or business, SSBT, the whole idea of 50% of W-2 wages limitation, 2.5% of adjusted basis. Just kind of, we know there's some limitations out there where not everybody gets the full QBI deduction. And so that is definitely a basic concept of being disallowed based on your income going higher. And also, as a general concept, there are just really a lot of unknowns, right? There's 184 pages of proposed regulations released last summer, a lot of comments from other tax professionals, and then IRS actually, credit to them, I don't know how they did this, but they actually released the final QBI deductions January 18th, and they were 247 pages. So I got a chance to look at those 247 pages, pretty intense stuff, especially in the middle of this government shutdown. A lot of new tax forms. I mean, the IRS customer service representatives definitely going to have their hands full with some of the questions that come in. It's just going to be an interesting tax season, as you guys all know. All right. So when in interesting scenarios, right, where there's just so much complexity in that, like, I want to see if we can pull back for a second and say our agenda when it comes to QBI deduction, especially for this first tax season, I feel like has to be very, very clear, and which is to understand and optimize. Understand what's going on and then optimize it for our clients. So that's kind of the lens that I want to do this training with, which I feel will be most helpful to you guys and most actionable. So specifically, first issue that we brought up: what inputs do I need to be concerned with in my tax software to make sure QBI triggers properly and also doesn't trigger improperly? So I'm not giving the QBI deduction when I didn't mean to. So credit to Lacerte for some of these screenshots. If you guys have double monitors, or even if you just want to pull up your software, there may be an opportunity for you to kind of follow along in your own software, because a lot of this stuff is going to be the same for different softwares. And I am actually going to have some slides for you guys as well, so you can kind of go back and be able to look at these slides and compare them to your own software. So Schedule C, there's kind of an area in where QBI issues are addressed. You need to check that box if it's a specified service trade or business. So you want to have some knowledge about what that means. Like a doctor, an accountant, a dentist, that kind of thing. There's going to be different rules specifically with the phase-out limits for that type of business. So you need to check that box if it is that type of business. If you also look here with that little 0 in the brackets, that means that there's an override. So unless you plug something else into this box, it is going to assume that all Schedule C income is qualified business income. So you're going to have a similar function in whatever software you're using, where it's going to try to take the Schedule C income and assume that it's qualified business income. If for some reason it's not, which I think would be fairly rare, you may have to make that override in this box. This issue of unadjusted basis immediately after acquisition, again, goes to those phase-out limits and some people getting their QBI deduction disallowed. You want to look in your software, you guys, on how your software is pulling in that information, because a lot of times it pulls it in from the depreciation screen. Like if you've been putting in fixed assets, there may be, again, an override in the software that pulls in that number, but that number may not be correct. You know, you may have written off certain assets entirely, you know, directly on the Schedule C or something like that. So just kind of realizing the data flow in your software. Aggregate business number, that's something that you see that and you're like, yeah, what's that? There's actually an option to aggregate business activities for the purposes of QBI. So that's an option on the Schedule C. And then if it's not a qualified trade or business, again, you have that option to say, hey, don't apply the QBI deduction to this, which Schedule C, you know, it really is not going to, you know, it's going to be qualified business income a huge majority of the time. So that's your Schedule C. The K1 inputs, you guys, in other words, to get the data onto the tax return for Schedule E, page 2. So it could be partnership, S corporation, trust, or estate, is a little tricky. This is the actual screenshot of where you need to put in separately. So you already put in the income from the K1, but you need to put in the business name, some extra information, similar to the Schedule C, to basically determine if there are any phase outs that need to apply. And I also want to let you guys know, I'm not sure if you saw this already, that on the K1s, so if you're sending out K1s, if you're doing S corporation tax returns, partnership tax returns, or you're receiving K1s, so for your individual clients, there are some new codes and new information on Schedule K1, which is supposed to include such things as whether it's a specified service, trade, or business, the wages, you know, that qualify according to the limit, and even the unadjusted basis immediately after acquisition. As well as in box 20, there are some new codes. I know you'll be excited about that. In box 20, some new codes, and they actually went from Z to actually having 2 letters now. So that's how deep it's getting on the K1s. Definitely look out for that and make sure you kind of understand that information flow between your software and the K1s. All right. On Schedule E, as far as rentals, this is an issue where it may not be qualified business income for certain rental activities. It appears to be from all the regulations that most rentals activities are going to qualify for QBI. But again, just get familiar in your software with how to manage the QBI deduction with regard to rental income. So how to optimize this part of the conversation, right, is basically to locate and review the inputs in your tax software. So that's not exactly Einsteinian, you know, recommendation, but it's something that you should do, you know, ASAP. Like I said, even if you have a screen up during this presentation and you're kind of, you know, walking along, or when we give you the slides at the end of the presentation, you can kind of, you know, just get familiar of where stuff goes in your tax software. So next question, right? We knocked that out. For the phase out situations, let's take a look at the actual worksheets. All right, so let's give an example here. This is a higher income married couple. You can see taxable income like $613,000, and you can see on line 9 qualified business income deduction. You see that WKS, which means worksheet, right? So that's going to tell you why are they only getting a $275 deduction. So let's dig into that. First, the good news would be that it's the only worksheet that you can actually order shots of Patron actually directly from the worksheet. Just kidding, guys. This stuff gets so deep, it had to have some kind of entertainment value. That means something totally different, but it did give me a chance to say that. This is going to be there's a few different versions of the worksheet, and you're going to want to test this out in your own software, right? So I'm going to run you through this in the, you guys are giving me some, are these mercy laughs or what? I actually thought that was pretty funny. You could order Patron from the worksheet. I mean, I don't know. But the, there's going to be different versions of the worksheet. You want to test it out in your software and definitely take a look at how your software is handling it. So the first part of the worksheet is what type of business it is. You know, if it's a specified service business, if it's aggregated. You want to determine your qualified business income deduction, kind of a starting point, right? So 20% of net income. And you're going to see here all the indicators as far as a possible limitation, right? So 50% of wages, right, allocated to that business. You're going to see the unadjusted basis of all property number, and you can see this 11,000 here was actually being pulled from the depreciation screen. So again, you just want to kind of understand that information flow. You have a limitation on this because it's over the phase out limits, and you're going to just keep following the worksheet down. $275, you're actually going to have a maximum deduction in this case of $275 because they are so far over the phase out limit, and the amount of the unadjusted basis of all qualified property is quite low. So it's $11,000, right? And it's measuring the phase out by just 2.5% of that. So that's what I'm talking about is if we don't understand like where that basis information is coming from, then there's a potential for this taxpayer to get limited to only $275 QBI, when in reality, if this number was higher and we had put in all their assets correctly, or optimally, I should say, then this number would be higher. So you can see that's the limitation that's kicking in. And again, just check through your own worksheets. I would just kind of advise you to do that. It's very informative. I hadn't done it before I set up this training, and actually learned a lot about how it works. So, you know, I got to run a few different tests for you guys just to make sure you kind of getting your money's worth from the training. I went ahead and reduced the income. So brought the taxable income down to within the phase out range for this married couple. And now let's take a look at that worksheet again. You can see overall the net business income is less. That's the starting point on line 3 for the QBI deduction. So that's 20% of net income. You can see the same kind of potential limitation numbers being run through lines 4 through lines 9. And you can see on line 12, there's a phased in reduction, and it says enter the amount from part 3, line 26. So that we want to go over to part 3 of the worksheet. And that's the phased in reduction. So it takes the original QBI deduction, and it takes the unadjusted basis immediately after acquisition figure, right? And it's going to phase out at a percentage of, so the phase out range, let me rephrase that. The phase out range is $315,000 up to $415,000. So that's $100,000, and whatever the amount that's over that of the taxable income, right, is going to develop a percentage, and that's going to be the amount that is not allowed for the QBI deduction. And again, you guys will get the slides, so you can kind of, this isn't the only time you're going to see it. We're going to give you the slides at the end of the presentation. You also have the recording. So I do need to kind of go through this a little bit quicker, but hopefully this is kind of showing you, you know, how this is working, because, you know, this is really the inner workings of the deduction. You can see there's so many things that if we don't have information inputted in correctly, our software could be doing stuff for us, you know, that we don't know what's going on. All right, so hopefully, and this is the obligatory blah, blah, blah section, you know, or it's not too common. You have the qualified real estate investment trust dividends, a qualified publicly traded partnership income. But, you know, it does come up, like say you have clients that have K1s from these oil and gas, you know, master limited partnerships, for instance. You know, this will come in as far as whether those qualify, that kind of thing. And it just continues down. In this case, the reduced income example, because the taxpayer is not totally out of the phase out range, they're just partially in the phase out range, they actually end up with a significantly bigger QBI deduction. So the previous, you know, very high income was $275. This time it's over 14 grand for deduction. So quickly again, run over what happens if it's a specified service business. then you're going to have to mark that in your software, and it's going to change some of the calculations as far as the phase out. So the phase in, this would be an example, you guys, that I made of, say there's not as much net business income, but the spouse and married couple has a higher income, so they're over the threshold. Then it is going to still kick in a phase out, and it's going to more aggressively disallow their deduction. So they're going to end up, they were trying to get that 14,000 QBI, and after the phase out, because they're over the income, taxable income threshold, they end up with like 6,800. So still good, but again, not the full 14,000. This continues through the worksheet, right? So depending what what software you're using, I see a few people saying, I don't have these in my software. There's going to be something that it should be equivalent in your world to be able to see how this deduction is being calculated, because all we're going to see on the tax return is line 9, right? Like line 9, qualified business income. So you got to understand where that number is coming from, because there's, especially with kind of particular situations for higher income business owners, there's a lot of there's a lot of opportunity to miss things. So to not get the QBI deduction optimized, and also to optimize it, where maybe one of your competitors would not be able to. All right, so it's a leverage point. Highly recommend you guys that you grab a good flow chart. I used to always joke about flow charts. I'd be like, oh, they're stupid. Like, who needs that? And they're actually pretty helpful. You just kind of follow along the flow chart. This was the best flow chart, I think, which came from accountants community into it. They're obviously very good at what they do, and this is really a good flow chart. But get the one that works best for you to kind of really dial in your overall understanding, and possibly even to communicate with clients, right, in a more visual way. So would recommend that. How to optimize, definitely run tests ahead of time in your software. Identify the in danger clients. So certain clients, higher income clients that are over those thresholds have possible loss of QBI deduction that others don't, and there may be some things that you can do to protect that QBI deduction, such as increasing the wages, aggregating business activities, maybe even changing the entity. And then lastly, for optimizing is a balance of communication with clients. Not feeling like you need to explain everything I just explained, right? Because clients could really care less. It's just going to be like, eyes glassed over, who cares, right? Versus, but some clients will have questions, why am I not getting this? Or I thought it was going to be 20%, all that kind of stuff, right? So just finding your balance of your communication style with clients is going to be a big opportunity for you guys and for all of us, this tax season and beyond, especially with business clients. So next up, right, just trying to knock these questions out one by one. Carrying over unused QBI to the upcoming year. How does that work? I actually was pretty excited about that. I was like, okay, it's almost like a net operating loss, and it's going to be something we can use in a future year. And I just got totally mistaken about what this actually means. Mistakenly excited. So I had to dig into the 247 pages of the regulations as part of putting this training together for you guys to make sure we have the most recent information. The carryover rules, negative total QBI amount, it's kind of like reverse of a net operating loss. It's actually, it's that any negative QBI for the current year is actually treated as negative QBI for the future year, which will decrease the amount of qualified business income available for deduction in a future year. So it's actually not helping a taxpayer. It is it's reducing their deduction in a future year based on a loss they're sustaining this year, potentially. And obviously there's a million different ways these things can go, but just is something that I did not understand at all. I don't know if you guys already know this stuff, but it was very surprising to me how that would work. So I was checking out, quote from BDO Capital Advisors. They put out a lot of good information. And they said, talk about a deduction amount negative. And I was trying to sit here thinking, like, how could a deduction amount be negative? I mean, what is that even like? What world are we in where that even makes sense, right? So what they said was any deduction amount beyond the 20% of taxable income is disallowed completely. If the overall deduction amount is negative, that negative amount will carry forward to net against next year's qualified business income deduction. So that was a real head scratcher for me. It was pretty interesting, pretty interesting dynamic, you could say. And so I had to go back to the worksheets, which are definitely a really nice feature of Lacerte software. I do see a few people saying they don't have that. That is one reason why it's a great software. So you can see here that this qualified business loss carry forward, that is going to be where next year, if you have losses for this year, then you can see on line 16, it says total qualified business loss carry forward minus 12,200. So that's going to have to be factored into one of next year's tax return. So you have a whole new carryover situation to kind of be concerned about, and it's not a beneficial carryover like finding a stock loss carryover, right? We're all so excited, and it's like, well, yeah, I found this, and it's going to benefit the client. This is more like I need to find this, or else I'm not going to correctly calculate QBI for the future year. So it brings up a question, like, will the IRS be auditing QBI mistakes or non-compliance? Because how many times is the person not going to bring the worksheet, right? Or just not even have that worksheet? That's definitely an open question. How do you optimize issues related to carryover, the carryover of a negative QBI deduction? Is identify the issues, especially with new clients. So you'll need to have some kind of idea of how to calculate that carryover loss that's brought forward. Possibly aggregating business activities for clients with multiple business activities, and taking a loss against from one business against a profit in another business, or possibly taking less of a loss this year. And I think, again, a lot of people on this you guys are more advanced, so you're familiar with things like maybe you elect out of bonus depreciation, don't take as many deductions in the current year to avoid this issue. And obviously that all depends on particular situations, right? I think that kind of goes without saying, but just want to make sure that is very clear. So next up, what is the impact on S corporation tax treatment? There are a few things that are, very much like thought through as far as how they pertain to S corporations with the QBI deduction, in terms of the 50% of wages limitation, right, was specifically addressing the fact that a lot of S corporation employee shareholders have kind of a lower salary, and also there's no wages, mostly on Schedule C, at least not for the owner, and a lot of S corps are doing lower salaries. A lot of the S corps are service businesses, so they might have minimal unadjusted basis in terms of buying business assets, or it might be unknown. We just never had to think about that before. 95% of businesses are pass through, so either Schedule C, S corp, or partnership. And source on that is Brookings Institution, and it's higher income clients a lot of times. So a lot of times they'll expect that extra level of expertise that you guys bring to the table. So it's definitely an issue. The big picture on it is, the basic math of why S corporation tax treatment often results in tax savings, right, is from self-employment tax. And that math hasn't changed. It's kind of still the same thing. Also worth noting is that taxpayers under $157,500 for taxable income, and then also $315,000 for married, are not affected at all by any of the limitations. So just kind of keep that in mind. None of these limitations on QBI apply if people are under those taxable income thresholds. Also, QBI, it does make pass-through tax rates roughly equivalent to the C Corp rate, again, generally speaking. Yeah, you guys don't worry about it. You're going to have a chance to watch the replay. You get a chance to get the slides. So I know we're going through stuff pretty quick, but again, we have really a lot of training for you guys. and also want to get to that Q&A for you guys because I know people are going to have specific questions. So we'll just want to keep it moving. You will get the slides and also get the replay. Active management for high earner S corporations. There's going to be situations where you're looking at an S corporation salary for the owner, for the employee shareholder, maybe near the end of the year, and you kind of get into some small print math, where you start having to look at like, okay, if somebody raised up their salary because they're losing part of their QBI deduction because 50% of salary is too low, then you start looking at, okay, well, the payroll cost is going to go up. You got to weigh that against the QBI deduction that you get more, right? And then what's their marginal tax rate? So you're trying to kind of see, like, it gets very confusing very quickly. And you have in little factors that you're going to keep running into here, like, okay, but no, then we're deducting the employer side of the additional tax cost. That's going to reduce net income. That's going to reduce QBI. So you kind of feel like, let's not get too deep into the weeds on this. But just to take a simple example, say you have a client with $240,000 net income from an S corporation. That, their 20% of that provisional deduction is 48 grand. So it's a huge deduction, obviously. Let's say this shareholder employee is only paying themselves a salary of 40 grand. That means that 50% of wages, right, is going to be is only going to give them 20,000. So they're missing out on 28,000 of QBI deduction, right? So if that's your client, you're obviously wanting to see if you can get them that deduction. So if you raise the salary, right, to get that full 48,000 to 96,000, but no, wait a second. Now the salary expense is going to drop net income, which is going to drop QBI. So it's just like where's the spreadsheet to kind of do that? And it goes back to the Patron comment from earlier. So those are just some of the kind of things that we're starting to wrestle with, pertaining to S corporations, also pertaining to partnerships. And again, it's only going to affect those taxpayers with kind of the higher taxable incomes, right? But it is something that when you have clients, these are things that we want to pay attention to because there can be significant amounts of tax at stake here. So how to optimize QBI for S corporations? There needs to be some kind of a function of salary checkup for higher income S corporation clients in terms of is their salary high enough to max out QBI? Some degree of familiarity of the unadjusted business or unadjusted basis immediately after acquisition for particular clients, if they have, especially if they have a business where they purchased a lot of assets, and just overall there's going to be more payoff. This is overall a trend that we see, across all tax pros, but there's just more payoff for being proactive when serving successful business clients. And there are some expensive and even embarrassing penalties if we don't think ahead. So it's kind of a double-edged sword. If we're thinking ahead with certain client groups, we can definitely, be proactively saving those clients money. But if we're not thinking ahead with those particular client groups, we can, be not serving them as well as we want to, right? All right, so next question, and also the final question before you guys absolutely roast me on the Q&A. So I'm expecting a roasting. How do I turn non-optimized QBI situations into paid tax planning engagement? So this is going to be something that you'll see, potentially for your own clients, right? Where, they're not in the best position to take advantage of this deduction currently. And there may be some things that you can do to help them, right? And also, this is going to be a potential client acquisition point for other tax preparers, right? So when another tax preparer is not, business clients can be quite demanding, right? A lot of you guys are business owners, so I know you probably can relate, right? If you don't feel like we're getting the best service and the best deal that we can, we'll probably start shopping around for another service provider. And so this QBI deduction and mastery of it is going to open up a lot of switching from one tax preparer to another. So a big goal here for us at Pronto Tax School, right, is to make sure that you guys are on the right end of that transaction, You know, you are on the ones that you feel confident about this stuff so that you can be able to acquire more clients and certainly keep your own clients happy. So, you know, it did give me a chance to you know, just say that tax planning is actually a rapidly growing you know, industry with all the tax changes that have happened. There's a lot of business owners that need to or would benefit from making moves. So it's definitely you know, a nice opportunity its own way. However, you know, I've tried this myself in different ways and kind of just figured it out over about the past, you know, I'd say 12 months of how to really get good at doing this type of work. And I think it starts with, if you haven't already done this, I know, again, you got a lot of you guys already have, just rethinking what we do for business clients. You know, what are we actually doing? And there's things seem to fall mostly. There's also tax problem resolution is a nice category. But in terms of sitting down with a client, right, during tax season, or if they file an extension, they're coming in later, you know, let's look at the pieces of the work that we're doing. We're doing tax preparation, right, which was backward looking, you know, filling out the forms, getting the tax return optimized as can be. It's all based on past information. Then there's tax projections, you know, like, okay, show me how I'm going to look if everything kind of stays the same, or if, you know, my income goes up 20,000, you know, clients often want that, right? And then there's tax planning, which would more be like, you know, forward looking and with some degree of advice or recommendations. So this is kind of how I think about it when we sit down with a client. I think that, you know, for you as a service provider to define a little differently, you know, kind of separating maybe some of these activities, you know, in your mind and how you communicate with clients is going to be a profitable start for you if you want to get into getting some paid tax planning going on. Now, a lot of times what happens, especially when you first bring up tax planning, you know, like we have some opportunities we can take advantage of, you know, you go into like your whole spiel. It's like, well, like, isn't that what I'm already paying you for? Like, aren't you supposed to already be giving me strategies for saving on taxes? So you kind of have to be prepared to have that conversation with the business owner, and just keep in mind that that is on a lot of people's minds. Like, why aren't you already doing this? But with all the changes, it's pretty easy to just say that, you know, there have been so many changes that we actually have a lot of demand from clients to be more proactive, to, you know, to save you guys money, and it does entail quite a bit of work on our end, depending on the situation. But, you know, it might be worth looking into if it could save you XYZ amount, or just save you any amount that makes it worth your time, right? So you kind of need to be prepared to have that conversation. When looking at this opportunity, I think it's very crucial to, you know, do the client selection properly, because barely anybody, you know, like as tax professionals, we kind of get excited, you know, if we're doing like projections, and we're like, this is so awesome, I can like see the future or what I like, but pretty much nobody cares to do the tax planning if it's not going to result in hard dollars saved, right? It's not, they're not something that people are jumping out of their seat to even do at all, even if it was free, let alone pay for. So the QBI complexities that we've gone over in this training, and other ones that I'm sure will come up in the Q&A, or create new opportunities, you know, to save hard dollars by taking proactive action. So that is great news, you know. However, it's a relatively few number of clients who really benefit the most. So you kind of got to look at what's the return on investment for the client, right? What's the tax savings that might be possible or is likely, and then kind of start with those clients first, so you can be able to segment your database. Or just, you know, keep that in your mind that it's only certain clients who are really going to benefit the most from these proactive tax planning engagements. All right. Once you kind of know who you're talking to and what you're trying to say to them, you're going to need to have a compelling ROI-based offer or offers, because the client is going to want to know, what is tax planning? Why do I need to do that? I think it's very important to not really go into all the features of the tax plan that they don't really care about, the clients don't really care about. And we have to, you know, in my experience, elucidate and really, you know, describe it simply, but also in enough detail, what are the direct and urgent benefits that the client will get from looking in a more proactive way at their tax situation. So example of a feature, right, be like you get a full review of your current tax situation. People don't really care, right? It's like, okay, you know, that's nice. But if you tell me why that's urgently needed or it's a direct benefit, you know, in order to alert you to areas where you're overpaying your taxes, then I'm going to be more interested, right? Anytime we're talking about an offer, there has to be a price. So you might get somebody interested in taking a look more proactively. And you know, that's obviously going to have to be said, what the cost is, what the price is, and maybe you have a couple, you know, different tiers of offers. I'm not sure exactly how but you definitely want to have your offer thought out ahead of time. And, you know, some people that are a little bit more on the slick side, right? But, you know, how much does it cost? It's free because it actually pays you to do it. In other words, you will get more back in savings than you will in the fee. And that's, you know, at the end of the day, most business clients, we are looking for an ROI. Now, obviously, you got to be very, very careful about promising savings and all, you know, again, I'm not saying to just fly off the handle and say anything that doesn't make any sense, but business clients are definitely going to be looking for that offer. Like, okay, say I'm interested in this, right? What's next, right? How much does it cost? When can you get it done by? You know, how much is it going to save me? And all those kind of details that business owners tend to make decisions based upon. All right. Beware, you know, especially if it's kind of a newer thing to you, a newer service, you know, with tax planning, tax projections, anything that's based on the future, you know, especially this, there are numerous unknowns, you know, that can happen. You know, maybe you don't know that this person starts up another business, right? You don't have that in your plan. What about licenses and insurance? You know, do you need a special type of insurance to do tax planning versus tax prep? You know, do you need an EA license, a CPA license? Just kind of, you know, be aware of what those, you know, finer points are. And, you know, at the end of the day, a lot of times the best laid plans don't work out, you know. So tax planning, I think it is a great opportunity, especially with regard to QBI and for business clients, but it is something to be a little bit careful of. You know, there are definitely risk factors, as Doug said. What's up, Doug? Appreciate you attending so many of our trainings. All right, so I think all that being said, right, we have to remember when we are talking, when we're talking about QBI, and especially if we kind of get into all the complications, right, that this is actually great news, right? Because we're going to have some clients that are like, you know, they don't want the extra time it's going to take to do this. You know, they don't want it to be more complicated. They don't want to hear all the explanations of X, Y, Z, and they don't want to pay a higher fee, right? So there's going to be some price adjustments that go on as for tax professionals that, you know, work with clients who have these issues. And I think it's really important to just have some kind of a script going. You know, definitely make it sound like yourself and believe it so that it's sincere. But something along the lines of, you know, I do understand what you're saying. It's kind of a good news, not as good news type of thing. The not as good news, you know, they did complicate everything again. And, you know, I say, I thought it was simpler, but, you know, did you hear that on the news or, yeah, anyways. But yeah, they complicated it again. And it's actually even more work for us. The good news is actually more than happy to do all this additional work related to this new deduction because you're actually going to save quite a bit of money on your taxes. And with a lot of business clients, you guys, there's going to be kind of a blending of the lower overall tax rates, also the new QBI deduction, the higher phase out for child tax credit, right? So, and also the doubling of the child tax credit. So you're going to have a lot of business clients that maybe are making like between $80,000 and $500,000 or more, that are saving like a lot of money on taxes from a number of things in the new tax law. So it is good news, and it's kind of all those things a little bit will flow together into a bottom line for most clients. Like, okay, I'm paying less taxes, but maybe I'm paying more for tax preparation or for tax consulting or for tax planning. So really got to keep it on the positive level, I think. And focus on the person is going to save money. If you want to, you know, do one of the old questions, you know, would you rather pay Uncle Sam an extra grand or pay us an extra $100? Most people would choose option B. So I see some really good questions coming in. I do want to leave plenty of time for questions. Tried to kind of power through that. I know it's a lot of information. You will get some goodies And let me go over briefly the special offer that we have for you guys. So recapping in terms of what do we really need to do for this QBI deduction is understand, optimize, and then communicate. So be able to communicate with clients effectively is going to be a huge deal, because we're going to get pulled into these rabbit holes, right? Where it's like, explain that to me one more time, or I just have a quick question. I have 8 businesses, and it looked like on TurboTax my QBI was like netting out against each other, and et cetera, right? So just understand, optimize, communicate. The thing is that this is also new, and this tax season is so intense in terms of the amount of unknowns that we'll be facing. We do want to give you guys a special offer, which is to join our Facebook tax preparer teamwork group. We've got about 400 very helpful tax pros in that group, and we've had it closed for a while. We've just been kind of working out how we're going to be able to provide support to you guys. And I wanted to just as a thank you for everybody that's been attending multiple trainings, and just as for you, investing your time to be here, go ahead and join this group free if you want to get support from a bunch of other tax pros, including paid moderators. So we actually have paid moderators that we're paying to support you guys within that group, and it's free. So if you want to kind of start at the free level there, you can just go to facebook.com/tax preparer teamwork. I'm going to post some goodies within that group. So the goodies are going to be, what did I have? I have my sources from this presentation. So I give you some links to some great articles. I'm going to give you the slides. What else am I going to give you? I'm just going to give you a couple other goodies as well. So the sources for the presentation and the slides for sure. And I'm going to see what else I can scare up for you guys and give that to you on Friday. If you join the group later down the line and you don't see that goodies post right at the top, just search goodies within the group, and assuming that nobody else posts a bunch of stuff with the word goodies, it should pop right to the top. You'll be able to find it. So if you join later, keep that in mind. Secondly, we have kind of the option for people that are like, hey, you know what? I see what you guys are doing at Pronto Tax School. I see you guys are going all out for us, and I know this is a crucial tax season. I actually want personalized, expert, 100% guaranteed tax support. We have been having a lot of requests for that program over the years. It's kind of difficult to figure out exactly how to make it work, and it does entail a good investment on our side to bring in the special personnel to handle that kind of thing and to dedicate the time during tax season. That is brand new. Actually, I wasn't expecting to be able to tell you guys about that, but Jeff ended up just beasting out and building out the page today and getting it ready for this presentation. So if you're like, I know I want support, personalized, expert, guaranteed tax support, just go to that page and you can check out our offer. Again, though, you can always start with the free version, which is the group, the private group. All right, so let's get into some Q&A. Thanks, Jeff, for marking the questions. I see some of the other comments you guys are putting in here are humorous, but I'm going to try to get to the questions. So Richard says, do adjustments to AGI reduce QBI? No, they do not, except to the extent, Richard, that they will reduce taxable income. So they don't directly reduce QBI, but because QBI is limited to 20% of taxable income, for certain taxpayers, adding an IRA or adding self-employed health insurance deduction, may impact that. You'd have to kind of, I got the wrong link. Tax preparer teamwork. Yeah, search Facebook, tax preparer teamwork. You'll find it. So you have to test out for that client, but it does not directly reduce QBI. All right, Michael, what's going on, Michael? Thank you for attending. Client has business loss for last year. She's converting to being a W-2 employee. What happens with the negative QBI carry forward, and how long does it carry forward? So the negative QBI carry forward, I don't believe there's any limit to when it carries forward. It's going to be a part of the tax return for the upcoming year to net against any potential positive qualified business income for the upcoming year. So it's going to be something that you have to deal with on the upcoming tax return. And if the person's running multiple losses in a row, right, it's going to definitely kind of kill their buzz, so to speak, when they do finally get their business profitable, because all those losses are going to kind of kick in. And that's a tricky little thing. Ingrid says, hey, Ingrid, how are you? Is QBI mandatory? Because it looks like it's not going to be beneficial to some clients. It's actually beneficial to all clients if they can get it. You know, any deduction is beneficial at any time, you know, to reduce taxable income. It's just a matter of like, does it actually save you money? Or, you know, is your taxable income already at zero? Are you phased out so you're like not eligible to get it? But we certainly would always want to claim the QBI deduction to the maximum amount that we can, because every deduction, you know, is going to reduce taxable income. And that's just very desirable for us as tax professionals. Terry says, elucidate. I need to charge $1,000 just for that word. I couldn't find a better word. That seemed to be what I was trying to say. All right, Doug has some good comments here. Hi, Tiffany. Tiffany just has a comment more so than a question. Many businesses, Schedule C, LLC, and S Corp don't have a lot of assets. That's definitely true. So that 2.5% of UBIA is going to be a very low number for a lot of those service-based type of companies. But for partnerships or LLCs that own real estate, especially, that 2.5% is going to be a much higher number, right? Because that real estate could have cost $1 million, right? So that's mainly what that limitation where it will come into play and be beneficial, is with real estate related partnerships or entities that own real estate. Vincent says, will there be a seminar on how to use Crosslink with QBI? This isn't too useful. I don't plan to do a separate seminar on it. However, if you follow along with the slides that are given, then you should be able to figure out where the inputs are for your particular software, and just follow along and work through it as best you can. Yes, the Crosslink software definitely works for QBI. Every software is working for QBI. I mean, this is the most important deduction for a lot of clients. So it's not like only one software is going to address this. How your software addresses it, you know, you certainly should investigate that, right? Or maybe contact your tech support and say, you know, where do I find how it's calculated? You know, that's why we're doing this training, right? So you can reach out, you know, follow up on your end and make sure you feel comfortable about using your tax software, because that's the tax software that you're going to be using. But definitely Crosslink is capable of doing this. So is Drake. You just got to reach out and kind of find out how it's working with that particular software. All right, let's see. Matt, hey Matt. What is considered a specified service business? If one is under the 157K mark, maybe a tax office or photographer with no assets, are they not applicable for the 20%? So first question, what is considered a specified service business? They just released, like I said, on January 18th, the new regulations that kind of clarified what is considered a specified service business. Is mainly going to be, you know, professions where your personal reputation, your personal skill is kind of the source of the income, is the tax theory on it. But you're talking about accountants, EAs, tax preparers, doctors, dentists, certain consultants. So if you Google search, Matt, and maybe I could get you, if you Google search, I hate to say just Google it, but Google search list of specified service businesses, they have a list available now. So you can look through that and see if you need to check that box on the Schedule C or on the you know, on the business income that you're entering. Now, if you're under the 157,500 mark of taxable income, remember it's taxable income, not total income, with no assets, are you not applicable for the 20%? No, you are completely applicable. So quite the opposite. If you're not over that limit, you have no limitation, if that makes sense. So you get 20% of the net business income regardless of whether you're a specified service business, how much assets you have, how much W-2, et cetera. None of that applies to you if you're under those amounts. And even if you go over those amounts, you still have a certain amount where you are phased out as opposed to completely losing the deduction. So test it out in your software, Matt. That's really going to be the best way for you to get a get a kind of get a bead on what's going on, right, and see how this works for particular situations. You definitely don't want to be examining those type of worksheets or those type of calculations for the first time when you're sitting down with a client and you have 5 other clients, breathing down your neck, right? So I saw here now where I put the wrong link for the Facebook group. So it's facebook.com/groups. So /groups/tax preparer teamwork. All right, so facebook.com/groups/tax preparer teamwork. Again, though, if you search Facebook tax preparer teamwork, you're going to find that group. We're opening it up to all you guys to be able to support you as much as we can this tax season, and for you to help the community as well. So don't forget, when you get in the group, don't just take, make sure to give, and let's all make this a team effort, right? So it's free to join. If you're more like, I know I'm going to have a lot of questions this tax season. I want to work with Glenn, with Andy, with some of the other paid moderators that we have available, and you want personalized, expert, 100% guaranteed tax support. So 100% guaranteed, we have a limited number of spots where we're going to be doing our support program, our paid support program, and you can check that out by going to go.prontotaxschool.com/UCN36. So always feel free to start with the free Facebook group. I know that's helped a lot of people. It's helped me several times. I had questions. But also, if you just kind of know you want to be in that first group of people that's getting that personalized, expert, 100% guaranteed tax support, then go check out the offer and let us know what you think. All right. So Terry says, I use Drake and they have none of this in terms of the worksheets. I would look into that. I mean, I know Terry usually knows what she's talking about. So that's possible, and knows more about Drake than I do. I think that there's going to be, in any software, there should be some calculations of, how the QBI deduction is being calculated, right? There should be some way that we need to see how that's being done by the software. So if you don't immediately see it in your software, contact your software company, where is that? Because that's information that we need to know. Otherwise, it's just the QBI deduction is just on line 9 of this postcard, right? And it's just like a number. So we don't know how it was arrived at or anything. And especially for these trickier situations, we need to know that information. So there should be a way that, your software can show you what it's doing. All right. So I got down to the bottom of the questions. Let's start again from the top. Okay. I have to watch this presentation again. Thanks for your presentation. Thank you, Zaida. Appreciate it. Thanks for the good words. I definitely wanted to make this a pretty intense training for you guys, and also, just give you free access to the group and the goodies that I'll be posting on Friday for you guys, just as a thank you for attending and being a contributor. All right. Mary says, I just checked out Drake. It's a simple worksheet, does not give you more. One on support and very limited. So yeah, I mean, so there's going to be a degree. This is all new stuff, so not every software is, has the resources of an Intuit, right? But there's going to be ways, for us to figure out how to calculate this, even if you have to do, some kind of I hate to say a by hand worksheet or a spreadsheet or something, but there's stuff out there. I just want you guys to realize that, when you see the deduction on line 9, right, it's we need to know what goes into that deduction, right? If it's being limited, especially if it's not 20% of the net income that I'm expecting, 100,000 net income, I want to see a $20,000 deduction, right? If it's not that, then I need to know why that is, and I need to get into that to make sure that we're doing everything we can for our client to make sure that they're getting the maximum deduction that they can. And I know that's how you roll. So that's, we need to see that information. We need to understand how that calculation is being made. All right. Michael has a question. On my last question, the owner has a loss and shut down the business and will work for another employer. Oh, I got it. Okay, I got you. Yeah, so my understanding on that, Michael, is that the negative QBI deduction just goes against QBI. So it doesn't interact with other income like wages income. So if the business owner shut down the business and doesn't have any business income for the upcoming year, it should not play into the tax return. I think your question about how long does it carry forward, right? Like, do I need to reach back 5 years to get a copy of the person, they started a business and lost money 5 years ago. I don't think the IRS has been very clear to my knowledge on that like how that exactly is going to work, you could say. And I'll pop you guys in this link here if you want to take a look at the actual 247 pages of regulations that were put out. There's the link right there. So you could do a Control F, and you could kind of look there, Michael, of if there's any comment about how many years that would carry forward. But I think it's a good point to say that it won't interact with other income like W-2 income. It's only qualified business income. All right. Let's see a few more questions here. Wayne says ATX has all the worksheets. Cool. Crosslink asks for a Q, S, or N. Who would be N? I don't know. Actually not a. The software is obviously very important because we use it every day to do our jobs. But you got to kind of take up some of the software questions with your software, with your tech support. And Vince posted a nice article there for Pro Series users. Very cool. All right, Denise has a good question here. What is REIT and PTP adjustments for QBI? So real estate investment trust income and publicly traded partnerships. So probably when you see that PTP mostly is when you have clients that have investments in like these oil and gas large partnerships. And the K1s, it's going to be really tricky with those kind of, you could say, I guess, more exotic forms of K1 income, because we're going to need to look on the actual K1 and look at the codes and look at, is it reported as a service trade or business? Are there allocable wages? Is it REIT income? Is it PTP income? There's going to be additional inputs on the K1, and those adjustments, those forms of income are treated a little bit differently for the QBI deduction than regular business income. So that's why they're separately broken out, and can impact people, that have that type of income. Okay, so Terry says, is there a list of what's considered a service-based business? There is, yeah. If you look in that link that I just posted, you guys, with the actual regulations, the 247 pages, that PDF, which I'll send you, that all those documents and those links as part of the goodies in the group on Friday, there is a list. So you can also Google search list of service-based businesses to see which fall in that category. All right, Mariana says, any Schedule C will get QBI as long as they are under the income limits. Yeah, exactly. Yep, that's well said. Any Schedule C will get QBI. I guess there conceivably could be some kind of Schedule C that's like not a qualified business income, but I can't even think of like what that would be. So it should be 20% of Schedule C as long as they have net income, right? If they don't have any net income, then it's going to be 20% of nothing. But as long as they're under the income limits, which, remember, those are taxable income limits, so not total income. Maristel says, for depreciation, can you use the assets from previous years that has not fully depreciated yet? Exactly. Yeah, that's what I was trying to point out, Maricel. Thanks for kind of clarifying that in case it's on other people's minds as well, because I know it was for me. Yes, like even if the assets are fully depreciated, it's unadjusted basis immediately after acquisition. So before you wrote off that truck that you purchased, right? Before you ran any depreciation on a rental property, it's like essentially the basis, like right when you got the asset. So if we don't currently have some of those assets of the business in our computer, right, then that's what I was trying to say, like understanding the information flow within the software, like where is this number coming from? Is it coming from my depreciation screen? Okay, well, that may not be all the assets of this business, and certainly may not be all the assets that were purchased 10 years ago, right? So if you're seeing, that's why I think pulling back from like, getting too deep into the weeds and realizing that, okay, there's phase outs and limitations that kick in, and what are the things that those limitations are based on. It's either going to be related to the W-2 salary for the owner. It's going to be related to the business assets owned by the business. So those are kind of the two trigger points that we really need to watch if somebody's not getting the full deduction or not getting any of the deduction. And I think it's a great question, great thought on your part to say, well, hey, let me take a second to think back, ask the business owner, tell me more about the assets that you purchased for this business over the years, right? Because that may be able to get them a larger QBI deduction. Mariana says, I have a lot of small business, painters, landscape, construction, house cleaning. Yeah, it's going to be a good thing, that's why I said it's good news. It's an extra 20% of net income deduction with the higher standard deduction, you guys, 24,000 for married couples. And, maybe a lot of Schedule C people don't have that much net income for certain clients, right? You may not have enough taxable income to get the full QBI or even to get any of the QBI. So it's not going to help every business client, especially those smaller, lower income Schedule Cs. It really won't change their situation. If they don't have enough taxable income, it can limit or eliminate their deduction. Let's just put it that way. So Danette Waters, welcome. How you doing? What rental activities qualify for QBI versus rental activities that do not? That's a great question. There was definitely a lot of thoughts at the beginning of like, is rental income going to qualify for this new deduction? They're using, you guys, this section 162 definition of trade or business. So I'm going to put that for you guys, and this link will also be on the goodies that I share with the group on Friday. But that is a good article that talks about which rental activities will qualify for QBI versus those that don't. And a lot of it hinges on whether it meets the definition of a section 162 trade or business. So that guy's a really good writer, kitsees.com, and that's a good link that you can check out for that exact question. But long story short, most people that are actively managing their own rentals, they should be able to get a deduction on that. Ron says, how do I get to look at this webinar again? You just check your email, Ron. It's going to be emailed, the replay. And maybe I can even also, I guess you guys already, yeah, you'll get an email with the webinar replay. So just keep an eye out on that. Doug says, what about Schedule E, hours spent in properties? What if more than one property, and does it apply if I file to group them? Yeah, so Doug's on that more advanced track. It's a really good question. There is that kind of aggregating properties election that is available for people that own different rental properties. That's actually separate from this new aggregation option where you can put together different businesses to maximize the QBI deduction. I have not seen a strict limit, Doug, on how many hours you're supposed to be spending on Schedule E. I don't think that they've spelled it out to that degree. If you look at the IRS regulations where I posted the link and again, which I'll share with the group, and you see something different on that, maybe let us know. But I don't see a hard limit on it. I see more of a, are you actively involved with this property? And Doug, since it sounds like he does real estate type of work, there's a limit, for instance, on claiming a real estate professional designation. Have to do at least 750 hours a year involved in the activity, right? So he's kind of investigating, like, what is the what are kind of the tests, if you will, for whether a Schedule E rental would qualify for QBI. And I have not seen, that specific number of hours. Again, if I just didn't read that particular paragraph on the 247 pages, definitely let us know. But I think it's more of a general idea, are you actively involved? And then, our understanding is that most rental property would qualify. What if more than one property? And does it apply if I file to group them? Yeah, exactly. You should be able to kind of group the properties and aggregate the properties. Strategically, let's say. Overall, like the whole tax law, as you guys probably have already picked up, is extremely favorable to, business income and especially, let's say, people that are earning a little bit more business income than somebody just getting by being self-employed, right? So kind of the more you're up the income scale, there are some other things to consider for phase outs and things like that. But definitely higher income business clients are going to see significant tax savings in most cases. So Annie the Ryan says, does the W-2 from other job also included in the limitations? No. So we're only talking about the W-2 from the actual business, right? From the business that you're seeking to get the deduction. But that's a good question. The W-2 income from other jobs not related to the business does not play in here. All right. So I actually see quite a bit of people still on the webinar, so I appreciate you guys. Any other questions here? Let's go ahead and fire them off. I'll get to as many as I can. Richard said, thanks, Andy, for the great webinar. So much new stuff. Thank you, Richard. Appreciate you, man. Martin said thank you as well. Thank you, Martin. All right, let's see. Terry said, I'm so confused now. No, you're not. Don't try to act like you're confused. You're not confused. You should be teaching this next webinar. I'm going to put you on here so you could teach. All right, guys. I haven't seen somebody completely stump me yet with a question, so I'm looking for some kind of question that I cannot answer. I will tell you, though, I did prepare pretty hardcore for this webinar. So did a lot of research for this one. I don't want to get up here, you guys start roasting me with all these questions. Let me correct the correct the link on the facebook.com. So facebook.com/groups/tax preparer teamwork, or just go onto Facebook and search tax preparer teamwork. So if you're sitting there saying, like Teresa just said, thank you, I have a lot to learn, right? Like, get in the group, right? If you have a lot to learn, you want to talk to other tax pros, you got questions, like, we've been running this group and it's great. We have certain people that are very, very generous and with their expertise and active, and this is really good. Like, you can post a question, you can get 6 or 7 answers within 20 minutes sometimes, and just totally solve your issue, and it's free. I don't know if I mentioned that it's free. So if you're more like, let me just upgrade right now, I know that they're not going to be able to do the support for that many people, especially with it being a new program, we're going to keep it fairly limited, but that you want personalized, expert, 100% guaranteed tax support, then you go and you want to look at kind of the upgraded option at go.prontotaxschool.com/UCN36. All right, so Terry has another good question, which says, are there going to be fines for messing it up? I haven't seen specific tax preparer fines, Terry, but there was some sneaky stuff that went on where the accuracy penalty, which is the kind of the understatement of tax penalty if a client gets audited, God forbid, and they get assessed a higher tax, they lowered the percentage of understatement where that penalty applies, and that accuracy penalty is actually 20% of the underpaid tax. So they lowered that amount to only be 5% of unpaid tax. So in other words, like if a client gets audited for QBI and it's not done correctly, like let's say for instance, you didn't bring over the carryover loss from a previous year, right? And the IRS computers figured that out and sent a letter, right? The 20% accuracy penalty is going to kind of kick in and more frequently, you could say. And so that is kind of a little bit of a backdoor way of making it more expensive, you could say, to kind of fiddle around, with this deduction or potentially not do it correctly. All right, but realistically, there is going to be a learning curve for everybody. So I don't think that anybody has the right to expect perfection, whether it's clients or even us for expecting perfection for ourselves, right? It's going to be a learning process. But hopefully this training, and any other training or articles that you've read, if you check out some of the other links that that I'm going to give you guys, just gives you some confidence, when you start to work with this issue, because I just don't want people, especially our members, go into this tax season and like just racking our brains like this is the first time we've seen any of this, right? And so I was trying to think like what kind of contribution could we make to this topic, because like I said, there has been a lot of other really good training and information. So I just wanted to do something like, what parts of this new deduction do I not understand myself and I want to understand better, and that usually gives me good ideas of what might be helpful to you guys, as well as a bunch of people reaching out to us and saying, hey, you guys need to do a training on this. So we had to wait till the last minute right before tax season. But hopefully you just got a lot of value in it. We'd love to see you in the Facebook group, the private group. It is free until January 28th, and which is the start of tax season. If you get in and you don't find the goodies that I'm going to give you, and you just want to search for them, if you join later or whatnot, or don't see it right away, then just go ahead and search for that in the group, and you'll find it. If you want to look at upgrading to personalized expert 100% guaranteed tax support, then go check out the nice page that Jeff built, and the nice offer that we put together for you guys that want a little more intensive support, for this crazy tax season that's coming up. So, all right, that's what I had for you guys. Actually, Mohammed has one. Oh, hey, Mohammed, how you doing? I do see one question. If you have more than one business, does the QBI apply to each business separately? Yes, exactly. So the QBI deduction will be calculated separately for each business. And then there are also some options, Mohammed, to aggregate certain businesses if it's more advantageous for the purpose of claiming or maximizing the QBI deduction. So definitely people with multiple businesses that's where a lot of the complexity will come in, and probably a lot of the value of your expertise. So people with multiple businesses, test it out in your software, right? So sketch it out, like put 1K1, 40,000 business income, Schedule C minus 12,000, right? Just play around with it ahead of time, especially as these business clients come in towards the end of tax season that have 4 businesses, have 6 businesses. Those clients are that you have a lot of value, that if you get familiar with how this works and what the strategies are and what the kind of tricks of the trade are, all legal of course, but just how to really maximize this deduction and just overall help your business clients as much as you can. That type of information and knowledge is going to be highly in demand. The self-employed and business market is growing rapidly. So, if you want to work in that, definitely check out where we're going to be re-releasing our Business Tax Verified program shortly. If you have questions, we're just basically here to help you guys as much as we can. And I think we got all the questions, as many as we could. It's a little bit later here where I am, so I'm ready to actually close this out. I want to thank everybody for showing up. Hopefully this has just given you some confidence to move forward this tax season, and just do your best. Do your best, and realize that if you want to be involved with people who have your back and actually want you to be successful, get into the Facebook group, right? Like, get allied with other people that want to work as a team with you, and let's all help each other. And if you want to take that next step to become a part of the brand new support membership program, we can help you out in that way too. So any other ideas you guys have for additional trainings that you want to see, for additional products, we're always listening and trying to build what we do based on what you actually need. So thanks everybody for attending, and let's just have a great tax season and a great year. Thank you guys.